We're starting with the brass tacks questions. And the first really being the features of this unlisted security,
Sure.
whether it is exactly the same as any company issuing, listed public company issuing shares, or could there be differences here? And how do we understand this as an equity instrument, first of all?
What you see in unlisted world is mostly common equity, but sometimes some of these convertibles also trade, right? So you have to be careful in terms of what you're really buying. And then, of course, there's the fact that, we also can't take away the opportunities that the unlisted world provides, right? There are a lot of stocks, a lot of companies that you simply can't find such and such industries in the listed world, right? We have, the world's biggest exchange in terms of turnover, being traded in the unlisted world, right?
Which is the National Stock Exchange,
Absolutely,
NSE,
right?
yeah.
Right. So those opportunities, while you can find similar, let's say, listed stocks, but this stock or this exchange that I'm talking about is unique in its own right, right? So you will get such opportunities only in a listed world that will draw a lot of genuine investors' interest. However, further to your point, you have to be careful about liquidity, right? Because if there was one thing that is paramount, should be on top of investors' mind in terms of what to expect from this world is the liquidity, right? So you have to be careful. The stocks can actually really go rampantly up and down depending on the liquidity or rather the lack of it. You have to be careful about and again, this is very unique. Because it is ultimately the transaction is not on the exchange, right? Transaction is across two counterparties.
Yeah.
So if I'm buying it from you, there is no exchange involved, there is no guarantee involved, right? So there's a credit risk to that extent.
Yeah. Deepak, come in on the point on just understanding the instrument that we are buying, even if it is common equity, and also where I as a buyer will stand in the hierarchy of investors. Because there could be the smarter guys, the venture cap guys, or private equity, all of that. So does everybody have equal rights? How do I know exactly what is this this piece of equity that I'm buying?
Oh, yeah. I mean, in fact, there's so many nuances here. It's no longer as simple as listed equity where everything is the same, right? So first of all, you have two types of companies, a private limited company and a public limited company. A public limited company can be unlisted. The difference is number of shareholders in a private limited company is limited to 200. So you may, there are other rules that apply. And then a public limited company has more open ownership. They can have more than 200. There are certain other restrictions. In a private limited company, they can actually say that the board of directors can refuse to transfer shares. So you own a shares of a private limited company. You want to sell it to me. The board can say, well, I don't want Deepak Shenoy on the cap table, so I'm sorry, you can't sell it. So they can do that in a private limited company. In listed companies, you cannot do this at all. So public limited companies are somewhere in the middle in this case. There is also the aspects of what share you're buying. Like Pranab said about the shareholding of common equity is basically the equity shareholder who's like at the bottom of the heap. Everything else is above that in the sense of other shareholders may have more rights than you. Common way to do this is CCPS, a compulsorily convertible preference share. But the preference shareholding has certain rights attached to it. There are four things that I'll talk about. One is that if it's a private, if it's an unlisted company, CCPS, which is above a common, can say that, listen, I'm giving you 1,000 rupees, but if the company's valuation falls or is the same, I will get my 1,000 rupees back first, and then my percentage ownership in the company will participate in any sale. So the company is sold for roughly the same valuation. The VC gets their money back first. You may get a lot lesser back if you own common equity shares.
Okay.
Then there's things called ratchet up clauses, which means if you sell at a lower valuation than they invested, their shareholding goes up. Consequently, your shareholding will also go down. There may be a right of first refusal saying, if you want to sell your shares to me, you have to go to the VC first and say, will you buy my shares at the same price Deepak wants to buy it at? They can say, yes, I'll do it. In which case, I don't get to buy those shares. They can buy those shares from you. So all of these clauses are parts of shareholder agreements. And the person you're buying it from, you need to actually ask them about the capital structure of this company. And then if you buy, the common equity could be 1,000 shares.
Sure.
But then the convertible equity could be 100,000 shares. So you may be thinking that if I buy 100 shares, I have 10% of the company, but it's actually 0.1%.
Thank you for watching CNBC TV 18 and do follow us on all our social media platforms for news, updates and more.